Financial statement analysis applications. In this reading, we will talk about the application of financial statement analysis. We will understand how to evaluate past financial performance. We will then look at how to project future financial performance. And then we will get into the two major reasons why analysts evaluate financial statements. One is to assess credit risk, and the other is related to equity investments. And finally, we will talk about adjustments to reported financials. Evaluating past financial performance. These points are taken straight from the curriculum and they highlight what we need to consider when we evaluate past financial performance. I will simply read this for you. As an analyst, you need to consider how a company's measures of profitability, efficiency, liquidity, and solvency change over the period being analyzed, and why is this happening. As the industry matures, a company might try to improve its efficiency. If you are a credit analyst, you might be particularly concerned with the liquidity and solvency of a company. These are items that we will see in more detail later. How do the level and trend in a company's profitability, efficiency, liquidity, and solvency compare with the corresponding results of other companies in the same industry? Or more specifically, you can look at the peer group. And then how can the differences be explained? What aspects of performance are critical for a company to successfully compete in its industry? How did the company perform relative to those critical performance aspects? And then what is the company's business strategy? What is the company's business model? And do the financials reflect the strategy? The curriculum gives several examples in this reading. Most of the examples are fairly long-winded. You can read the examples if they have time. I think they are very interesting, but from a testability perspective, they are just a few core points that you need to recognize. And what I'll try to do in this lecture is highlight those important points. The first example is a case study on Apple, and it showcases how Apple's change in strategy is reflected in its financial performance. In the early to mid 2000s, Apple primarily was a personal computer company. Its sales came mostly from the Apple Macintosh or the Mac. But then Apple changed its strategy and the focus moved away from being purely a PC company to a company that provides several integrated products. And if you look at Apple in 2010, it had the iPhone, Apple sold iPads, iPods, music was downloadable through iTunes. So the product mix changed substantially. And if we look at Apple's revenue and the mix of revenue coming from different sources, we will see that that product mix and the corresponding revenue changed substantially between 2007 and 2010. So what that tells us is that the financial performance is reflecting Apple's stated strategy. Apple's strategy involved selling differentiated products. So Apple is a major innovator in its field. And when a company sells differentiated products, it can charge higher prices, which is what Apple does. And that should be reflected in higher gross margins. If we look at Apple's gross margins between 2007 and 2010, as the strategy was being implemented, the gross margins are actually becoming better. So that again reflects the fact that the financial numbers do point out that the strategy was working. The impact on operating profit margins is weaker. The reason is that for a company that is providing differentiated products, innovative products, there still needs to be a substantial amount of investment in R&D, in marketing, and so on. These relatively high costs will have an impact on profit margins. So just because a company has differentiated products and higher gross margins doesn't necessarily mean that the operating profit margins will also be very high. The example also showcases Apple's liquidity. If we look at the liquidity ratios, they are quite high in the 2 to 3 range. This says that Apple had a lot of extra cash, or at least a lot of current assets relative to liabilities. There are several reasons why this might happen, and there are several ways in which a company can use that extra cash. One interpretation might be that this would be inefficient usage of funds, but another explanation would be that this is like Apple's war chest, where the extra liquidity could be used to make acquisitions. Example 2 highlights the effect of differences in accounting standards on return on equity comparisons. Return on equity is net income over equity. We are looking at 3 telecom companies. One is Verizon in the US, which uses US GAAP. Then we have a telecom company in Mexico using Mexican GAAP, and a company in Brazil using Brazilian GAAP. It is a long example, but the main point is that differences in accounting standards can have a substantial impact on financial ratios. In other words, it does not make sense to take the unadjusted numbers for, say, return on equity and simply compare them. If we do want to compare these 3 telecom companies which are using different accounting standards, we need to first make sure that all the numbers are presented in a particular standard, US GAAP for example, and then it makes more sense to compare ratios. This example shows that after we make adjustments, the change in ratios are quite significant. Next, we talk about projecting future financial performance. The first thing we need to do is forecast sales for a company, and what is presented here is a simplistic way of forecasting sales. We first forecast the expected GDP growth. Then we forecast the expected industry sales based on historical relationship with GDP. So if historical data tells us that a 3% increase in GDP corresponds to a 3% increase in sales, then we use that. In some industries, a 3% increase in GDP might have a much higher increase in sales numbers. This relationship between increase in GDP and the company sales or the industry sales is available by looking at historical data and doing regression analysis. We should then consider the market share of the company that we are evaluating and whether that market share is going to change or not. If the market share is not going to change, then we can simply say that the increase in sales will correspond to the increase in the size of the industry. Based on this information, we then forecast company sales. Then to come up with the estimated net income, we have to forecast expenses. We can use historical margins such as gross profit margin and operating margins for stable companies, and this works for companies such as J&J, which are large and diversified and stable. For companies which are not stable, they might be new companies, a company like Facebook for example. Here we need to estimate each expense item. We should also remove any non-recurring items because with our forecast we are concerned about revenue items and expense items that will recur. Those that will not recur should not be considered in our forecasts. Generally, we estimate interest expense and tax expense separately. The reason is with interest expense, the amount depends on the level of debt and the rate. So we have to estimate the debt that we expect in the future, and we need to estimate the interest rate, and it is the combination of these two which will define interest expense. With tax expense, we need to have an estimate for the tax rate, and obviously the earnings before tax, which will be calculated based on the forecasted sales and the forecasted expenses. Once we have the EBT and the tax rate, we can come up with the tax expense. To come up with cash flows, we also need to estimate changes in working capital. If our working capital, such as inventory, is going up, that is not reflected in the income statement, but obviously it has an impact on cash flow. So an estimate of changes in working capital is important. We should also estimate investment expenditures, because these will not be reflected in the income statement, but they also impact cash flow. We need to estimate dividend payments and so on. Again, these are just high level points. With this information, we can then project the cash flow for a given company. The level of analysis presented here is simplistic, but from an exam perspective, this should be reasonable. The curriculum presents several examples. Examples 3, 4, and 5 are fairly long. If you have time, you can read them, but what I'll do here is give you the most important point related to each example. Example 3 deals with using historical operating profit margin to forecast operating profits. We are given the example of a stable, diversified firm like J&J. For a company like J&J, it makes sense to use historical margins to project future operating profits. Whereas we are given another company, which is a Chinese search engine company that is relatively new. There, it would not make sense to use historical operating profit margins because of the uncertainties involved. There, it would make more sense to project each expense item separately. Example 4 deals with issues in forecasting. The most important point in this example is that we need to recognize which expenses and which items are non-recurring. So these items are not included in our forecasting model. Example 5 is a basic financial model or a basic financial forecast. This is a spreadsheet model, and I don't think this is overly testable. The example here is based on the discussion from the previous slide. So if you know all the items from the previous slide, you are reasonably well prepared from an exam perspective. Example 6 is a multiple choice question. It tests your knowledge of ratios. I would strongly encourage you to do this example from the curriculum. Assessing credit risk. Imagine you are considering the purchase of a bond that has been issued by a company. One of your major concerns will be whether the company will make its coupon payments and whether the company will make its principal payment at the end. The process whereby you assess whether or not the company will make its payments is called assessing credit risk. You can also call this credit analysis. The high-level items that you will be concerned with are the ability of the issuer to meet interest and principal payments on schedule. To do this, one of the most important things you will look at is cash flow forecasts. This will look at the amount of cash flows and also the variability of cash flows. If the cash flow is very volatile, then obviously that will be a concern, because if the cash flow is low, then there will be a question as to whether coupon payments will be made. You also need to consider the business risk and the financial risk of a company. When we say business risk, what we are talking about is the risk of the company not having sufficient revenues or the risk of expenses being too high. Financial risk arises when the level of debt is high, which means that interest payments are high. If the operating profits are low and debt is high, then the company is in a very risky situation because all the operating income might get used in paying interest. The curriculum gives some specific examples on assessing credit risk, and I will again highlight the most important points. You need to look at the size and scale of the company that has issued the bond or issued debt. You need to look at total revenue. You need to look at operating profit. You need to look at the business profile, revenue, sustainability, and efficiency. If a company has relatively high revenue, which is sustainable, and the company is operating efficiently, all these are indicators that the credit risk is good. Good credit risk means that the company will make its payments on time. You should also consider financial leverage and flexibility. With leverage ratios, we are talking about ratios such as debt to equity. Low ratios are good because for a given amount of equity, if a company has low debt, that means that it will easily be able to make its debt-related payments. Coverage ratios such as EBIT over interest, you want these ratios to be high. High ratio means that the operating profit is relatively high compared to the interest payments. Debt over EBITDA, you want debt to be relatively low, and EBITDA, which is a proxy for cash flows, should ideally be high. If this ratio is low, that's a good thing. Free cash flow to debt, you want free cash flow to be relatively high and debt to be relatively low. So if this ratio is high, that is good. By good, we mean low credit risk. We should also be concerned about the liquidity of a company. The classic liquidity ratio is the current ratio, which is current assets over current liabilities. If this ratio is high, that means the company will easily meet its short-term obligations. If you have time, you can read examples 7 and 8, which basically highlight the material shown on this slide. Screening for potential equity investments. The idea here is straightforward. If you are an equity analyst and you want to identify certain stocks to buy, you can look at their financial data to identify which stocks to focus on. Here is an example of screening criteria. You might be interested in companies that have a price to earnings ratio of less than 15. The price is the stock price. The earnings refers to EPS, which we have calculated in an earlier reading. A low EPS means that you are paying a relatively low amount per dollar of earnings. So you might put in this criteria, and from your universe of stocks, you might identify 100 which meet this criteria. Then you might be interested in companies that have relatively low leverage. So you could look at the assets over equity ratio. Less than 2 means that you want relatively low leverage. Here you might identify 50 companies that meet this criteria. You might want companies that pay dividends, and here you might identify 75 companies. And then if you want companies that meet all 3 criteria, then the search might reveal that there are 25 companies that meet these 3 criteria, and then you can spend more time researching these companies. What I have shown here are simply examples. There can be several other criteria that you could use. This material will be covered in more detail when we do equity. If you are an analyst and you want to keep your risk low, then what sort of criteria are you likely to use? Again, there are several criteria that could be used, but you might, for example, say that the earnings have to be positive over the last 5 quarters. You might say that the leverage ratios such as assets over equity need to be relatively low, and there are other numbers or other criteria that you can use also, but this just gives you an idea. If the analyst wants low PE firms, then obviously he should have this criteria, maybe less than 10, which are financially strong. When we say financially strong, what we generally mean is low level of debt relative to equity. So we might say that the debt to equity ratio needs to be quite low. We might give a criteria such as debt to equity must be lower than 0.2. We need to recognize that there are different kinds of equity investors. We will mention this briefly over here and then see this in detail when we do equity later. Growth investors. These are investors who are focused on investing in high earnings growth companies. So typically companies that might have a growth rate of 20% or more. When companies have high growth rates, typically their price to earnings ratios tend to be high. Value investors are focused on paying a relatively low share price in relation to earnings per share or book value per share. Here, the PEs will tend to be low. In the US context, the PE might say be less than 10. Book value per share refers to assets minus liabilities. That's book value divided by number of shares outstanding would be book value per share. If you are buying companies that have low book value per share, that means they are relatively inexpensive. Market investors are an intermediate category. You need to understand this term called backtesting. This is where you evaluate how a portfolio based on a particular screen would have performed historically. Let's say that we go with the screen that was discussed on the previous slide and you've identified 25 companies. Backtesting means that you go back, say, 5 years and you run that same screen. You identify companies that meet the criteria, and then you see how would those companies have performed over the 5-year period. Since you are going back in time, you can actually look at whether your screen would give you stocks which produce a good return over the next 5 years. When you do backtesting, there are some biases that you need to be aware of. These biases are mentioned briefly here and they will be discussed in detail later when we do equity. An important bias that keeps showing up in the level 1 curriculum is the survivorship bias. This exists if delisted companies or companies that have gone out of business are not considered. If we only consider companies that have survived till the end, then our returns will tend to be overstated because we are skipping or missing out the companies that might have gone out of business. Look ahead bias exists if the database of companies that we are considering includes financial data updated for restatements. This means that there would be a mismatch between what the investor would have actually known at the time of the investment decision and the information which is being used as part of the backtesting experiment. And finally, data snooping bias might exist if excessive analysis is applied to the same data set. I'll not get into more detail here because we will see this later. If you have time, cover example 9 that deals with the topics that we have discussed over here. Analyst adjustments to reported financials. When comparing ratios, adjustments might be required, and we have seen examples throughout the FRA material. Different companies might use different accounting standards. With inventory, for example, one company might use LIFO, another company might use FIFO. If you are comparing ratios that involve inventory, you have to make an adjustment. For example, both companies need to be presented as FIFO before you can make a comparison. However, before making adjustments, there might be some items that you should consider. One is the importance. Here we consider whether the adjustments that we are considering will really impact our decisions. If we are evaluating a company where inventory is a very low percentage of current assets, then it might not make much sense to do the LIFO to FIFO conversion. We should also look at whether the companies we are comparing are using the same body of standards or different body of standards. If different standards are being used, then it would generally be important to make conversions. Methods. When we compare companies, we should look at whether they are using the same accounting methods or different accounting methods. For example, you might have one company that is using straight line depreciation, another company might be using accelerated depreciation. Here, adjustments need to be made. And finally, estimates. Continuing with the depreciation example, two companies might be using very similar assets, but one company might be depreciating over 10 years and the other company might be depreciating over 8 years. So we need to recognize that the two companies are using different estimates, because of which there will be differences in expenses and income. Coming now to some specific adjustments. A lot of what you will see here is a recap of material that has been seen earlier. Adjustments related to investments. Let's say that company A classifies financial assets as available for sale and company B classifies similar financial assets as trading or held for trading. If you remember the reading on balance sheets, you will recall that any unrealized gain is shown as other comprehensive income if the financial asset is classified as AFS. The unrealized gain is shown as income in the income statement if the asset is classified as trading. This means that the net income numbers will be different for the two companies. And if we are comparing the two companies, then an adjustment is necessary. Inventory. I have already mentioned this. If you are comparing two companies where inventory is significant, one company uses FIFO, the other company uses LIFO, then we need to make an adjustment. When companies report inventory using LIFO, and this is only allowed in US GAAP, or we should say it's allowed in US GAAP, it's not allowed in IFRS. When companies report using LIFO, they are required to also provide a LIFO reserve. This is a number that when added to LIFO inventory gives us FIFO inventory. If a company reports LIFO inventory on 31st December 2010 equal to 100, that's LIFO inventory. In the footnotes, the company will also disclose a LIFO reserve. Let's say the LIFO reserve is 10. What that means is, if the company had reported using FIFO, then the inventory would have been 110. What the footnote might sometimes say is that if inventory had been reported using FIFO instead of LIFO, then the number would be 10 more. The point being that the term LIFO reserve is sometimes used explicitly, sometimes it's only in the English that the footnotes explain what's going on. Example 10 shows us how this adjustment is made, and effectively it is this simple calculation. Example 11 talks about adjustments to inventory values before comparing current ratios. Clearly, if you have two companies and you are comparing the current ratios, it makes sense to first bring the inventory to the same system before comparing. Goodwill. If you recall, goodwill is put on the balance sheet when a company acquires another company and pays more than the net fair value of assets. So consider two companies A and B. Both are identical except that A has grown through acquisition and B has grown organically. Organically means that it has grown on its own, it's not acquired other companies. What is the impact on goodwill and total assets? Obviously, the company that has grown through acquisition will have a higher goodwill number, which means that it will have a higher asset number. So the equity will seem higher. But does this mean that company A is better? The answer is not necessarily. When we compare company A and B, it makes sense to look at what's called the tangible book value. This is the book value of assets minus liabilities, where we have removed the impact of goodwill. So we remove goodwill and then what we are left with is tangible book value. At times we might also want to remove intangible identifiable assets such as copyrights, patents, and so on. So strictly speaking, tangible book value means that we are only considering the value of tangible assets. Estimates related to property, plant, and equipment. The information on this slide is fairly self-evident. We can study the balance sheet and income statement and make estimates about the equipment that a company has. For example, if we look at the number of years of depreciation expense which have been recognized, let's say we want to estimate this number, we can simply look at the total accumulated depreciation so far divided by the depreciation expense. If we want to see how many years of useful life remain for the company's overall asset base, then we can look at the net property, plant, and equipment divided by the depreciation expense. The rest of this table is fairly self-evident. Coming now to adjustments related to off-balance sheet financing. You have seen this material in the reading on non-current liabilities. Many companies use operating leases because they make ratios look better. If you recall, operating leases are a way of doing off-balance sheet financing. You don't put any assets and liabilities on the balance sheet. You as an analyst might want to evaluate the impact of capitalizing the operating leases. So you might say, what is the impact on the assets, liability, equity, and so on if these leases were treated as capital leases? To do so, you need to make adjustments. The first thing you do is compute the present value of operating lease payments. Let's say the present value of operating lease payments is 100. You then add 100 to the value of assets and 100 to the value of liabilities. This material should sound very familiar because we have done this before. What is the impact of making this adjustment? If you look at solvency ratios such as debt to equity, when a company shows 100 more as liabilities, that means the debt part is going up. Equity is the same because both assets and liabilities are going up. So notice that overall solvency ratio is going up, which is a bad sign or a negative sign. What about coverage ratios? Coverage ratio, the simplest one is EBIT over interest. The major impact comes in the denominator where the interest amount goes up because we are now paying a interest component when we have a finance lease. So the denominator goes up, which means that overall the coverage ratio comes down, which is negative. So note that generally speaking, when a lessee goes from an operating lease to a capital lease, then the ratios become worse. That brings us to the end of the reading, a summary of the important points. You need to evaluate a company's past performance and explain how the strategy is reflected in the financials. The Apple case study that I spoke about briefly is a good example. You need to know how to project net income and cash flows. The big item there is you first project sales. For a stable company, you can project expenses based on ratios. Even for a stable company, you should generally project the interest expense separately based on debt and interest levels, and you should also project the tax expense separately based on revenue and expenses. To assess credit quality, the big thing to consider is cash flows. If cash flows are stable, then the credit quality generally will be good. We talked about data in financial statements to screen equity investments. If you want relatively safe companies, then you will put criteria that says that earnings need to be positive, dividends need to be positive. Maybe you can also say that the leverage ratios need to be less than a certain number, and so on. And finally, we talked about making adjustments. We need to recognize where and when adjustments help. Once we have recognized what adjustments need to be made, then we need to know the proper steps for making adjustments. Before comparing ratios, we need to make sure that we are comparing apples to apples. That's what adjustments is all about. As always, read the summary. review the learning objectives. I have mentioned several examples. Most of the examples are long-winded. The MCQ example that I referenced, you must do that. If you have time, then you can read the other examples. I think they are useful general knowledge, but not overly testable. Practice problems are great, extremely testable. Do them very carefully and also try to do practice problems from other sources. That is it.